So for example, if you are a producer of an agricultural good and you have some time to kind of plant the seeds and harvest it, maybe 1 or 2 years, you can already sell your harvest today, and then you have a fixed price, and you can plan ahead, look how much to plant and so on. So it's reducing risk. And on the other hand, a company that needs this agricultural good or plant as an input, they already can kind of secure their supply by entering the opposite end of the forward contract. So that was kind of an example for kind of a useful application of this, but also since there is no kind of cash flow today, basically you can kind of speculate in the direction of the market without having any money to put in. And that's why it's also very popular among speculators. I'm going to show you some more applications later on. So for example, how Lufthansa is doing their fuel hedging strategy. So they're also selling airline tickets in advance, and they need kerosene for their planes. I want to show you, they're quite transparent about how they do it. I want to show you how they use these kind of products to do that. We discussed the basic contract, and this basic contract basically works the same for kind of stocks, bonds, commodities, and a little bit more complicated was the one for foreign exchange or currencies. And I'll ask you to kind of have a go at this as a homework assignment. So maybe let's start with, let's see if there are any questions regarding what we've done last week. This would be a good time to address them. Otherwise, let's just jump right into the solutions here. Okay, so let's remind ourselves of the question here. So we want to buy a certain amount of US dollars ahead. So we amortize it to $1 US. At the forward rate, and the forward rate here was unknown in this example. The only thing we know is the current exchange rate. So of course, this is not kind of the current one anymore. So when I did the example, that was probably 2 years ago. That was the current exchange rate. At the moment, it's roughly 1. Actually, we do have a number open here. So the current exchange rate is 1.03. Almost parity between US dollar and euros. And we have the interest rates for those time periods. And at that time, the negative rate in Europe and a slightly positive rate for the US. So these were the rates from government bonds, basically. Good. So I already kind of wrote down the cash flows for the forward transaction. Remember, there's always a 0 at time equal to 0. And then we have our forward transaction. So I get $1 US, and I have to pay a certain amount of euros for it. I've labeled this amount to be with the variable X. And the reason for that this is actually not the forward price, it's just the price notation. So the way how the exchange rates are typically quoted is in US dollars per euros, right? But if you write it down like this would be euro per US dollars. Right? So to get to the exchange rate, how it's quoted, we just have to take the inverse of that. Good. So then let me ask you, has someone found like a strategy, without kind of going through the exact numbers, but has someone identified a strategy of how we can replicate this cash flow using the information that we have here?
Short selling.
Yeah, so what would you short sell here?
So I will borrow money, I will borrow euro to buy the $1 US today.
So, you see?
Well, I have to borrow 0.843 euros to get the dollar today. And since the interest rate is minus 0.7, I'll have a profit at the end of
So already good at Europe, but then you have $1 US today, that you want to have $1 US in 1 year.
I want to have the that's the
So the US dollar, the one for the US dollar is in 1 year, it's not today. So basically, I think that was a good start, but it's just incomplete. So you need to do one more thing. Right, so you borrow money in euros, and then you convert that to US dollars. Then you have US dollars today. But you want to have US dollars in the future, so how do you get the money
I
there?
have also invested the US dollar, like with $1 with let's say interest rate is 1.001, and then you get this profit of 0.001. You say exchange into euros later, and the F01 for both is the same as in forward.
Yeah, so like investing in US dollars is kind of the missing piece, right? So you borrow here in euros, you move that to times 0, then you convert, and the converted amount will be moved to the future again by investing in US dollars. Right? So you put that on a US dollar bank account, let's say. Right? Okay, so the thing here is that you have now borrowing and investing in both currencies, and the difficulty is to figure out in which currency do I have to borrow and which currency do I have to invest. Right? So if you look at the cash flows here, that might be helpful. So in US dollars, you want to receive a payment. If you receive something in the future, that's an investment. And here, you want to pay euros in the future, so if you pay money to someone else, that's like borrowing, right? You repay a loan to a bank, that would be negative cash. So when you have a minus here, it's borrowing. If you have a plus here, it's investing. And the exchange between the currencies can only happen today because the only information that we have is the one on the current exchange rate. Right? So that's what we have to move all cash flows to today, then do the conversion, and then let's see what number we can get. I'm actually doing it in the exact opposite direction than you did because I have this here is an unknown amount, so I don't know yet how much I have to borrow, but I know this number here for sure, so I'm going to do it exactly in the opposite direction. So the first one would be investment in US dollars. So I want to invest exactly that much that I have plus $1 in the future. That's my objective. So how much do I, like if that's a bank account or if you buy a government bond, like how much money do you have to put into the bank account today? Well, that would be 1 discounted by the 0.1%. That's minus 1 over 1 plus 4.1%. And that would be minus 0.999. So then I do the currency conversion at the current exchange rate. Right, so since I have a minus here, I need US dollars, so I need to get US dollars here, so that cash flow will be positive and that will be negative. So I want to convert exactly that how many a certain amount in euros to get exactly 0.999 US dollars, and the amount I have to put in is 0.8424 euros. Let me kind of put this up here how I computed this. So this is the minus 0.999 divided by the current exchange rate, which is 1.1859. Or conversely, if you put in this amount of money at this exchange rate, you should get 0.99. So this is an amount in euros. You multiply with US dollars per euro, so the euro cancels out and the US dollar remains. Always have to be careful because I personally mess up the units in these exchange rates so often. Yeah, but this is I think the correct direction. Okay, and then finally, I need to have these 84 cents in euro today, right? I don't have them, so now I need to do the borrowing that you proposed. So I take a loan in euros. And and I borrow exactly as much to have 0.8424 today. And then I have a certain repayment, which will be 0.8424 multiplied with 1 minus 0.7%, because the negative rates. And that amount is minus 0.8365. Alright, so if you now sum up all the columns here, you'd see that this adds up to be 0, this adds up to be 0. Then I have $1 here, and I have my amount X that I was looking for. So I need to put in roughly 84 cents today, 1 year, to achieve this. And then we can plug this in up here in the equation. And then we have 1 over 0.8424, and that gives me a forward exchange rate of 1.1955 US dollars per euros.